Well, joining me today is Craig Hemke, a long-time contributor to Sprott Money. He's known for connecting the dots between global monetary shifts, policy signals from the Federal Reserve, and how they ripple into gold and silver markets. Well, as both metals hit record territory this week, Hemke's thesis on gold revaluation and the monetization of central bank balance sheets feels probably a bit more relevant than ever. Well, Craig, good to have you with us.
Devin, thank you for having me on. It's a pleasure to visit with you.
Well, listen, we're watching gold trade at record highs while the US dollar remains relatively strong, right? What does that divergence tell you at the moment about the market's faith in the current monetary order? Is gold now reacting less to dollar moves and more to sovereign credit risk or balance sheet confidence? Where do you see it?
Well, in terms of the dollar index, that's more of a kind of a daily thing. It can often act as a headwind or a tailwind and for the computers that trade gold and silver futures, because it is mainly high frequency trading computers these days. Over time, though, the dollar index just simply compares the dollar to other fiat currencies that are all devaluing at about the same rate. So you can go back, the dollar index is about 100 now, but you can go back 10 years, 20 years, 30 years ago and see it at 100. So there are periods when they trade together. There are periods they trade opposite, but a lot of times you can just kind of see it as a headwind or a tailwind. At the end of the day, the dollar is a great way to measure the gold because, as I often tell people, the gold isn't changing. The same ounce of gold is the exact same that it was 10 years ago. It's just that 10 years ago, it took $1,100 to buy it. 5 years ago, it took $2,000 to buy it. Now it takes more than $4,000. It's the dollar's purchasing power that is changing. The gold remains the same.
Now, you've written extensively about monetization of the balance sheet, right? To what extent do you think this rally reflects markets starting to price in a quiet form of that? That is a world where you have that fiat expansion continuing under different branding and gold becomes, a collateral anchor again.
Well, when you're following gold, you got to follow it so many things on a daily basis, macroeconomics and monetary policy and geopolitics and politics. And I've run my own site for about 15 years called TF Metals Report. And there I write an annual forecast every year, usually at the end of December, trying to sum up what happened and mainly just to figure out what I got wrong, because like anybody else, you're going to get more wrong stuff than right. But it allows me to look back and then look forward to try to apply that into the next year. And what I missed last year was this central bank demand. That has been so strong since 2012 and has really put a physical floor under the price of gold that has just been continually moving up. Okay, so fast forward to the end of last year and Trump gets reelected, I guess you could say. And after price going down to begin with, while the dollar rallied late last year, all of a sudden price has taken off. And there was I think what will turn out to be the biggest, I think they call it an Easter egg sometimes, right? When you find something that's kind of hidden in plain sight. On February the 3rd, Trump was in the Oval Office signing an executive order authorizing a sovereign wealth fund.
Yeah.
And he turned, and the Secretary of the Treasury was right there next to him. And then somebody asked a question about, well, how are you going to fund this thing? And he looks and he goes, Scott's got some questions or got some comments on that. And Secretary of Treasury Besson kind of shuffled his feet and kicked around and, like, I wasn't supposed to talk today. And he very clearly said they have plans to monetize the asset side of the balance sheet. And really, it was from there things started to take off in February. He's tried to walk that back a few times, as you might expect. He even tried to claim that he said mobilize. No, Scott, you said monetize. And I think we're now seeing, especially here in the last 4 or 5 weeks, where price has just been consistently rising, regardless of technicals and other things that might have scared people off in the past. I think we're starting more people are starting to figure out what may be in play here.
Yeah. Now, while we've got that thought process going on, let's take the spotlight. I want to shine it on silver, right? Silver price action of late has been explosive, outpacing even gold. Do you see that as confirmation of industrial scarcity and investor rotation, or as a sign of, the structural stress in the physical silver market, especially in London and Shanghai? What's your thoughts on that?
Yeah, it's really a little bit of both.
Yep.
There's a lot of momentum chasing in the futures market, a lot of these kind of CTA funds that are out there that are chasing the price higher. Silver often creates its own momentum. There was a theme earlier this year was, well, gold's going crazy and silver, anywhere near an all-time high yet. What's going on? Well, silver will often do that. It'll sit there and do nothing and then kind of build on its own momentum, and a price rally creates more momentum and more people, more eyes on it, and up it goes even further. Silver has a couple things going for it. Obviously, this physical issue that might have to do with the U.S. wanting to kind of hoard it as a critical mineral. London appears to be running a little short, as you see in the price charts, where the spot price is above the futures price. A lot of stories in London of lease rates and challenges to borrow the SLV, all these signs that would make you think that they're a little short on physical metal, backing up all their unallocated trading over there. Yeah. But the other part is, and again, it's a physical story, as you mentioned, Devin. There's 800 to 900 million ounces of supply deficit cumulatively over the last 3 or 4 years, where the world is chewing up more silver than it's producing. A couple 100 million ounces a year, that's having an impact too. But finally, just kind of back to that momentum. Gold went up, breaking out early 2024, banged up against its old all-time high and consolidated for about 90 days, and then finally took off in early March of last year, and has since doubled in price in 18 months. So now here's silver catching up, now breaking out to its new all-time high. I mean, it's not inconceivable that it's just going to keep playing this catch-up game, provided gold stays high. Yep. I mean, it may double in the next 18 months as well.
All right, so you mentioned something that you missed last year, right? Policy-wise, central banks keep buying gold despite high prices. What does that tell us about their view for the next decade? And do you think they are preparing for a different kind of, let's say, reserve system altogether?
I think they have been since the great financial crisis. I think that caught a lot of the foreign central banks, BRICS nations, whatever you want to call them, a little off guard. I remember writing this in my annual forecast back in 2023. The seminal moment, the biggest thing that happened in 2022 was not the start of the Ukraine war. It was 2 weeks after, on a weekend early in March, when the U.S. froze Russia's foreign currency reserves that weren't held domestically in Russia and also kicked them out of the SWIFT system. You can directly relate that to the buying spree of central bank gold buying that has been on a tear ever since, with record amounts every year. Because I think any sensible foreign government would look at that and go, okay, we may not be at odds with the U.S. and the hegemon here and their control of this financial. We get along just fine right now, but it may not always be that way. Yeah. And so we better. I mean, if they can do this to Russia, they can. They at some point our interest may not coincide with theirs, and they may try to kick us out too. So there's that kind of rationale for setting up maybe a parallel system. Beyond that, though, what central banks are doing is no different from what I've always done, and probably what a lot of people watching this has always done. Central banks have accumulated dollar reserves through foreign trade. I accumulate dollar reserves through work. Whatever I don't spend is savings. Whatever the central banks keep are their foreign currency reserves. What do I do with my savings? I diversify out of the dollar into gold. Yeah. Well, that's what these central banks are doing as well. They're just simply diversifying some of their savings into gold, again, on a much larger scale than you and I and anybody else, but it's the same thought process.
And look, I want to end, Craig, by asking you, I mean, for ordinary investors watching these records unfold, right? I mean, what's on their mind? Is it time to accumulate or to hedge? How do you think, about the entry points and where we are at all-time highs?
Well, even as opposed to the last 5 or 6 days where it seems like it's been going straight up, probably not going to keep going straight up. The pattern in gold since that breakout a year and a half ago was a 15 to 20% rally followed by a 3 to 4 month consolidation. This current rally is just now exceeding 20% from the breakout in late August. So there's got to be another consolidation coming, and silver will as well. I would use that period to maybe start to accumulate if you haven't already. With a reminder being, though, if you were to sell your silver or sell your gold, they're going to give you currency in return, whether it's US dollars or Canadian dollars or whatever. Well, then what are you going to do, right? I mean, that currency is just being devalued year after year. And then the last thing that I tell my friends all the time, gold is not like a stock, where you could say it's now suddenly expensive and maybe the fundamentals have changed. Some company, their margins have decreased, or some traditional fundamental thing has changed to the company, and therefore you think, well, I got to get out of this thing. It's expensive. Like I said earlier, the gold doesn't change. The gold is just a measuring stick. And so you can't look at it as being expensive. You got to look at it as the dollar just getting less and less valuable. And if you believe in the math, if you realize that the U.S. debt is not going down and it's going to reach $40 trillion next year, and it's just going to be consistently getting worse, and you know that things like yield curve control and more QE and everything else is pending next year, the amount of dollars it's going to take to buy that ounce of gold and that ounce of silver is only going to keep going up over time. Not straight up, but it's going to keep going up over time.
Yep, interesting to watch. Well, look, thanks very much indeed, Craig Hemke, long-time contributor to Sprott Money. It's indeed a pleasure talking to you, Craig.
Hey, Devin, thank you for having me on. I appreciate it. It's been fun.